so far, we talked about how to decide in our investment which project should we in or which project should we reject, and that was possible by applying the net present value approach, NPV approach, or sometimes you can have more discussion by using the BCR ratio, sometimes in case of the capital rationing situation. And then if you want to apply this logic into real world situation, real world problem, then there is another problem. So in the previous examples, I provide you what will be the cash flows for the project. But actually in reality, you yourself need to decide what are the cash flows for this project. So you have to determine that I can get $1,000 in the next year, I can get $800 in the second year, so on. So it depends on not only just conducting the NPV methodology, but also to determine the relevant cash flows matter in real world. And we have two principles governing regarding the determination of the cash flows. First, cash flow principle. So sometimes people are confused, and then they take into consideration of some irrelevant cash flows into the calculation because they are confusing about the accounting profits and accounting cost or expenses. So some of the items that you will find from the project description, they are not actual cash flows, but they are just accounting terms which are used to modify or to adjust your balance sheets and the income statements. Therefore, you should not take those things into the calculation because we are doing finance, where we need to care about the real cash flows and their real economic values, and that means we don't have to put accounting incomes or expenses into consideration. And second, there is a with or without principle. So generally, if you are working for a company, then this company will have a lot of projects together. And then sometimes you are confused because you have a lot of cash flows from different projects together, so that whether you have to include this one or not. And general principle is that you have to think about two different situations. So first, let's say you accept this project, and what happens to your cash flows. And second, let's say you don't accept this project, and let's see what will be your cash flows. And if there is a difference, that means this is a relevant cash flows. On the other hand, if in either cases you observe the same cash flows, then this cash flow is not relevant to your investment because this will be always in your firm's cash flow whenever you whether or not you take this project or not. So that means actually this is not for the project. So we want to only care about the cash flows which occurs because of this project. So that is the with or without principle. And based on these two fundamental ideas, we sometimes face different issues from the real world situations, such as depreciation, working capital, sunk costs, and allocated costs. So we are going to think about those things, whether should we have those cash flows or those incomes or those things into calculation or not, by taking a look into the next example of Plasteel. So here, this Plasteel Communication, this is a company that produces some mobile devices and other electronic devices, and there are a lot of divisions in this company, and one of them is a handheld device division, and Ms. Nina Sanders is a newly appointed manager of this division. So as a head of this division, she wants to know what are the projects that is on our consideration. And according to other executives in this division, they have a proposal, they have a project which can be beneficial for the firm, which is manufacturing a smartphone with flexible screens. And according to others, the existing employees' calculation, this is profitable because when they had conducted financial analysis, they found that the net present value is 35, which is positive. So that means the company needs to take this investment opportunity. However, we are not sure whether this is true or not, so we are going to take a look in this project. So let's see what are the items from the top line to the bottom. So first, to manufacture the new smartphones, we need plant and equipment, so we need some facilities. So today, if we take this project, today we are going to invest $30 million to have this plant and equipment, and it will work for 5 years. And you cannot have an infinite period, because when you produce new smartphone, then suddenly the market will move on to the next designs on other models. So we only expect that we are going to earn for the next 5 years from this new model. And therefore, after 5 years, there's no need to maintain the plant and equipment. So we are going to sell it. So by selling it, we are going to have the salvage value. So we have a positive cash flows at the end of 5th year. And second, we have a working capital. The working capitals are some things such as the cash and cash equivalents, the accounts receivable, accounts payable, and inventories. And because we are producing and selling those products, we need to have some kind of those assets, and then that will be the working capital. So let me talk about this after a few discussions. And third item in our project evaluation is the preliminary engineering. So according to the employees, they already spent $2 million because they wanted to establish a plan and establish the design, and they wanted to design this new model. So they already spent it. And this is the $2 million. So maybe we need to care about this $2 million if we are going to have this new project. And the fourth one is the excess capacity. So although we are investing $30 million for our producing facilities, this is not all. So we are going to use some of the idle facilities that this company already has. And at this moment, the other division had prepared this facility, but they don't have any plan to use it. So we can just freely use it. So that's why we have a zero value here. So we can use others' facilities for free. So we have zero, and it means the total investment by adding this all, we have $46 million spending today for this production. And we have sales estimation thanks to the marketing team. And we also calculated the cost of sales, what will be the production cost. And then we have an interest expense. So to have this, we are going to borrow some money from banks, and therefore we need to pay the interest expenses. And the allocated expenses, there is no allocated expenses yet. I'm going to talk about it soon. And we have sales and administrative expenses also. And then we have depreciation. So we start with $30 million facilities, but we end up with $15. So we have 5 years to depreciate them. Therefore, for every year, we have $3 million as the depreciation. And that's why we have this. And finally, we have income before tax. as 17, 26, 51, 58, and 43. And then we pay 40% of the tax to the government. So by taking out of those taxes, we finally get the income after tax. And by combining these operating cash flows and the investment, we have the cash flows final cash flows from minus 46, 10, 16, 30, 35, and 41. And if we calculate the net present value with respect to the 15% of the discount rate for 1, 2, 3, 4, 5, 6 cash flows, then we have the net present value at 35, which is positive. Therefore, we do this investment. So that was their conclusion, but Nina Sanders wants to clarify on some of the issues. So let me talk about them. Especially, we are going to think about those bolded lines because they have some errors. First, let's think about the working capital. The working capital is the set of resources required for the project or the firm's project on its daily businesses. So, for example, we often observe that a firm has cash and cash equivalents, accounts receivable, account payable, and inventories. So they are all necessary and they are produced as a byproduct in your operation. Therefore, we can also imagine that for a small project, we are going to need some of them. So for example, let's consider that I'm going to open a convenience store 24/7 right on the opposite side of this building. So I'm going to operate it. And then by just having the inventories, this is not all, but I also need to prepare for payment. For example, I need to prepare some of the bills and the coins because some will use the cash instead of credit cards. So I have to maintain a certain level of money in my store. And therefore, I cannot use them because I have to be prepared for the customers, and that will be the working capital for the convenience store. And similarly, for a large firm or a project, you need working capital, and then it means you cannot spend those working capital on other projects. Therefore, you have an opportunity cost. In other words, you need to consider working capital as a cost or expenses because you cannot use it on other projects during the project. However, one thing, by the way, we often measure the level of working capital depending on this term, net working capital, and this can be calculated as the difference between current assets and current liabilities. And working capital must be considered as they did because they are relevant because you cannot spend those money on other things, so you have an opportunity cost. However, there's a small problem because at the end of this project, so you are going to get the money back. So they do not disappear, but they are there. They are staying there, but we cannot just use them. So we have to say that at the end of this project, we are going to get the money back, the cash and cash equivalents from the balance sheet. So therefore, and we have to make a modification. So if we go back to this, so we have an increase in the working capital at the beginning, but there's nothing happens in the upcoming years. But we have to say that at the end of our project, we are going to get the working capital back to the company. And one more thing is that we often observe that the level of working capital changes over time. So as we have done when we did the forecasting, we often see that the amount of inventories, amount of account payable, account receivable, they all change depending on your sales. So when you have more sales, you need more working capital. And when you have a lower sales, you don't need that much working capital. So you also need to consider that the level of working capital changes over time. So we are going to assume some of the new things. So we are going to think that depending on our new fund project, we need working capital as the 20% of the sales. And for each year, we can estimate the required working capital. So in today, we don't need working capital because we didn't have any sales yet. But in the first year, we estimate that the sales will be 60, and because 20% of the 60 is $12 million, so you need working capital of 12. And we didn't have working capital yet for this moment, so we are going to put 12 into the working capital. So we have a minus 12 as the cash flow. However, in the second year, something's different because in the second year, the sales is 82 and 20% is 16. So you need 16 working capital. However, you already have $12 working capital in position. So only additional $4 million is required for your operation. So therefore, you don't have to put 16 additionally, but you can only just put $4 million more in the second year. And in the third year, similarly, because you already have 16 and you are required of $28 million as the working capital, the difference between these two, 12, will be required. And that will be your cash flow. Similarly, on the fourth year, in aggregate, you need 31. However, you already have 28. Therefore, you need only 3. In the final year, you already put 31. However, now this is the end of your project, so you are returning. You are getting all the working capital back. Therefore, you are going to have a positive cash flow, not the negative one. So this will be the changed working capital, which is more correct. And the second was the sunk cost. So the second line was about the preliminary engineering. So the other employees told that they already spent $2 million, and therefore we have to consider those $2 million. However, this is true because whether or not you do the investment, you already spent them all. Therefore, it does not change. So according to the with or without principle, it doesn't matter. So you have to forget about the past. So economically, the sunk cost is the cost that has already been incurred in the past. And now we are thinking about the future benefits and the cost from the project. However, we cannot change the past because we don't have a time travel. Therefore, we have to just forget about what happened in the past. And that means you should not think about the preliminary engineering expenses because it is already the sunk cost. So you don't put this into consideration. And the third line was about the excess capacity. So to be honest, the handheld division is getting some benefits from other divisions because there is another division called the switching division, and they already purchased these facilities in asset, and then they had no plan to use it, so they are just putting it for free. So we will be able to use their facilities for free for a while. However, the switching divisions had come to the Nina Sanders and say, hey, we have another plan to use those facilities, so give me those facilities back. And that will be the problem. But at the beginning, because this is in idle and the firm has no plan to use it, so it is more appropriate to set its cost as 0 because we can use it for free. However, maybe after 2 years, they have another plan to utilize it, and then we have to return it, and then we have to prepare or we have to buy additional facilities for our production. That means in 2 years, we are going to have another cash flows occurring as our expenses for new facilities. So therefore, we are going to change it also. And the next thing was about the interest expense. So basically, the firm will have some financing, and interest expenses and dividends, they are all called the financing cost. However, we do not consider the financing cost when we think about a single project. So when we think about the overall project in a nutshell, we think about the financing cost because we want to know about the financing problem. However, if we just want to think about a project, we just assume that we already borrowed and we already taken care of those financing issues. So we think that we already have those resources, and then we just think about other things. And another issue is that actually we are taking care of the financing costs already. So when we calculate the cash flows, when you calculate the present value from the cash flows, we discount those cash flows with respect to the discounting rate, and the discounting rate is based on the interest rate you have. Therefore, you are already saying that because I am borrowing at this interest rate, we have to discount the future cash flows. So if you take a minus as if you consider both the interest expenses and the discounting rate, that means you are double counting. So to avoid that situation, you just only consider financing costs in the discount rate, not by taking those as the negative cash flows. And there is an allocated expenses. So sometimes, in many times actually, there is a firm, there is a company, and there is a management team, CEO, and other divisions like and human resources department, and we have those divisions, and one of them was the handheld division, and we have some projects, so we want to calculate the present value of this project, and because we are a division, Dina Sanders is the head of the division. She only cares about the profits from the project, and she ignores other functions of the company. So that was the reason why we didn't have any allocated expenses in the first projection. However, this is not true. So other employees and executives are existing, and because of them, this project is possible. And therefore, we have to consider some of the indirect cost, overhead expenses, such as executives and employees' salary, the cost of maintaining offices, the expenses for our meetings, and documentary expenses. We should consider them into calculation. And generally, what we do in reality is that we have an internal some kind of guidelines. How much should we consider as our indirect expenses? And according to this Plasteel company, this company has a rule that for each project we apply 14% of distribution. So we have to consider those costs into calculation. And this kind of procedure is called as an indirect cost allocation. And lastly, we have the depreciation. So this has a huge impact on your evaluation of a project. So depreciation, as you already know, depreciation is not an actual cash flow. It only occurs in accounting term, but it doesn't happen in reality. And then according to the cash flow principle, we should not take care about the depreciation. But the problem is, actually, depreciation has some kind of effect on our project. By having a depreciation, we can have a smaller tax expenses. So let me go back to the previous projection at the beginning. So before we calculate the tax expenses, we take out of the depreciation from our operating income. Therefore, our operating income is reduced as much as our depreciation, and as a result, we don't have to pay a lot of taxes. So we have a tax shield effect from the depreciation. So you might remember that we have an interest tax shield effect. At the same time, we have a depreciation tax shield effect. So therefore, it is helpful for your project when you have a depreciation. And then we have to calculate the taxes based on the depreciation. Therefore, we have to think about the depreciation when we evaluate a project. But we already said that the depreciation is not an actual cash flow. Therefore, we have a two-fold procedure for taking care of this. First, we deduct depreciation from our operating income before calculating tax expenses, because thanks to the depreciation, our tax expenses are reduced. Second, because depreciation is not an actual cash flow, so we add back it to our calculation so that we actually find the true valid cash flows from our project. So we have changed several things, and that will be our modified projection about this new project. So let me start from the beginning. So we have a change in the working capital. So as we already did, we are going to set the working capital as the 20% of our total sales. Therefore, the required working capital changes for every year, and then we have some negative cash flows. However, at the end, we are going to get all of the net working capital back. And second, we should not have preliminary engineering, even though we already spent them, because this is a sunk cost. So we set 0 for this. And now for the first 2 years, we are going to utilize some idle facilities. However, the owner of the facilities, the other switching division, has another plan. Therefore, at the time, in the second year, we have to purchase additional facilities for the production. And because this is also a fixed asset, then we will have a salvage value. So we will be able to have 14 at the end by selling those new facilities. And sales are there, and we set interest expenses as 0 because this is a project, not the firm in a nutshell. So we are going to ignore the interest expenses. And then we have allocated expenses, and according to the company's guideline, they allocate cost equal to 14% of sales. So that's why we have 8, 11, 20, 22, and 17. And also we have depreciation into calculation before operating income. Before income before tax, so that we have a lower tax payment. And after that, after calculating the tax, we have to add back the depreciation. And that will affect our after-tax cash flow, which will become 11, 14, 25, and 27. So we have a final cash flows from this project, and by considering them, we can calculate the NPV, the net present value, at 15% of the discount rate. So that is a more precise version compared to the original version. So this is the true NPV that we have from this project.